What's going on, my fellow wealth creators? Matty Ice here. Welcome to another episode of Fun with IUL Comments. We're going to have a good time today going through some of the really interesting comments that have been left on some of my videos. I think that, for the most part, this is pretty productive because, it's good to see both sides of the argument and just have a, productive back and forth conversation, even though sometimes it's not really productive. Some of the things that people leave are very misinformed and just kind of flat out bizarre. But, it's good to go through these things. Some of them are brings up questions and stuff, and I think it's important to address them. So let's hop right into it. I'm going to share my screen. We're going to go to the first video that we're going to go through with comments here. This video is one I did recently about my second infinite banking policy that I just set up. Really excited about it, and I'll show you guys how I designed it based on my specific goals. So make sure you check that out. But let's get into the comments because Sleepy Sammy definitely does not agree and had some choice words for me about it. So, this person has left a lot of comments on my videos, and I've invited him to get on my channel and to have a conversation with me about this, and he just will not do it for some reason. But you got plenty of time to drop and leave a bunch of comments, so it's kind of interesting. But anyways, he says, I noticed the guaranteed numbers, you don't break even until year 20. That's true, but I don't know why you're looking at the guaranteed numbers. It's the absolute worst case scenario. That would be like me saying, hey, look at the guaranteed column in an IUL illustration. That's what you should base your decision on. Look how terrible it is. That's ridiculous because going based off the guaranteed numbers is assuming that this company is never going to pay another dividend for as long as I have the policy. They've never missed a dividend payment in 146 years. So I'm pretty sure they're going to continue. Are they guaranteed? No, but you know what else isn't guaranteed? The stock market going up every single year like your Fantasyland IUL illustration shows. So I don't know what you're talking about. But, if you want to go there, you definitely don't want to look at guaranteed numbers in an IUL illustration because it shows the policy lapsing 99% of the time, even when it's structured properly. You look at a guaranteed column in an IUL, it's pretty useless. I'll show it to you. And Sleepy Sammy has actually commented on me bringing this illustration up because I have done it before in the past. And this is a real illustration, a real policy that was sold to somebody, and it's not properly designed. I'll get that out of the way. But even still, even when it's properly designed, a lot of times you look at the guaranteed column or part of an IUL illustration. Look here, age 61. You see that 0 right there? It means your policy's dead. It's gone. It lapsed. You know what a whole life policy will never show you in a guaranteed column? A lapse, because it just won't. It's guaranteed to grow every single year. So I don't know why you're trying to call out the guaranteed column of a whole life policy. That's assuming that they're never going to pay a dividend again. It'd be like me saying the stock market's never going to go up again. So your IUL is pointless. Like, come on. Like, let's be a little bit more realistic here. All right, he thinks it's the worst rate of return he's ever seen. In the guaranteed column, yeah, the rate of return is not very good. But we're not buying these policies based on the guaranteed column. I'm banking on the fact that this company's probably going to pay dividends long into the future. So when I look at the non-guaranteed side of my illustration, which I'll pull up here, let me zoom in here a little bit. You guys I'm not going to do a full breakdown of this, but just to show you what he's talking about. Like right here, 0 cash value, and it takes 20 years to break even. That's I'm pretty sure that's accurate. This is the guaranteed side of the illustration, but the non-guaranteed side is what includes the dividends as well. And that's what actually gets a pretty decent rate of return for a savings vehicle, not a stock market product. But typically these policies will get 3.5 to 5% net tax-free compound growth. And then when you add the tax-free aspect of it, you got to add at least another percentage point, maybe 2 on top of that rate of return, depending on what tax bracket you're in, because that's not factored into this. What rate of return would you have to earn in your actual savings account in order to get net, let's say 3.5%? Well, you probably have to earn like 4.5, maybe 5, give or take, to account for the taxes that you pay in that savings account. So for a savings vehicle, the rate of return is pretty good. I pulled this up as well. And, you can see it right here. The past, 40 plus years internal rate of return, about 3.6%. And, people like Sleepy Sammy will say, oh, that's a horrible rate of return. Well, we're talking about a savings vehicle, number one. And what's the rate of return on an IUL that lapses? I'm pretty sure it's massively negative because of all the money you lost. But anyways, we'll get to that later. So, nothing, nothing to get super excited about as far as rate of return goes, but we don't set these policies up for rate of return. At least I don't. I consider the rate of return, whatever that is, 3.5%, 5%. I consider that a bonus, and add it up over time, or compound it enough, long enough over time, or a long enough period of time. Those numbers can get pretty big. It can be pretty impressive. Also, I think here this is based on like a 100% base policy, because there's no cash value here, but with dividends, so I'd have to double check on that. But and mine is not 100% base policy. It's I set it up 25, 75, 25% base, 75% split. So it's probably going to be better than that. But yeah, rate of return, again, he's using the guaranteed cash value. I dare you to look at a guaranteed column of an IUL, which Sleepy Sammy is a very big advocate for. My last policy design was really bad, according to him. It's not. It's really good. Guaranteed rate of return. We're not talking about the guaranteed rates of return. Okay, so moving on. Just kind of useless. So this was the same comment right here. Let's go to. So you left a comment on my other video breaking down my infinite banking policy. My first one. All right. So he says, I really don't want to open up new questions before you answer the first set, because I keep telling him to get on my channel to have this conversation. He just refuses to. First set of questions, policy. Okay. Literally wasting $375,000. This is going to be interesting. I ran an illustration showing $375,000 less going into the same whole life policy, which is not true. You would have to put it in with like the same exact company, the same, like you have no idea like what I put together here. I believe you show 1.7 million or 1.07 million. I'm sorry. That is correct. This is my first policy. I ran an illustration showing only 700,000 going into the same with the same cash results, which is not true, because he shows the cash results right here and they're very different. He did a 50-50 split. I used a 25-75 split, which is typically more efficient than a 50-50. So again, I'm not going to believe this until I see the illustration that you ran, what company you did it with, because your illustration might have 6.2%. I think like Mass Mutual's dividend rate right now is like 6.2. Mine on this particular company was 5.3. So it's always going to be. There's always going to be some variance there, but like you're nitpicking stuff here that I just don't care about, to be honest. Like, I'm thinking about what I'm going to be able to do with these policies, and I set it up perfectly for me. And so let me break this down here really quick, and then we'll finish the comment here. When I set my policies up, one of the things that I'm trying to accomplish is getting large amounts of money out of the banking system. That's a big thing for me. So I that's why I always do like a pretty large lump sum upfront, like front load. I front load these policies. One, to supercharge the policy. I get access to tons of cash value in the first year. Like, it's good. And then I do a 25-75 split because I want a little bit more of that death benefit up front. But otherwise, like one of the things that I like doing with these policies is, because I just don't trust the banking system. How many banks have failed over the last 100 years versus mutually owned life insurance companies? While banks fail, mutually owned life insurance companies pay dividends. Just do the research on it, guys. And actually, I've done videos on this. You can find them on my channel. But I feel much safer having money with these life insurance companies versus the bank. So that's another part of my design as well that you probably did not factor into that illustration you're talking about. So that's also why like having this conversation in the comment section is just not very productive, because there's so much missing context on both sides with this. So let's see. He said with his illustration, at the end of 40 years, he has 2.55 million. And I have 2.8, which is a $250,000 difference, give or take. I'm pretty happy with that. So, but his claim is that because he used $375,000 less, that's why my policy sucks. It saved him in his illustration $122,000. But there's so much missing context there. It's ridiculous. Like it's just a stupid claim to make. Not to mention, guys, I'm pretty happy. Like at 75, I'm going to be pretty happy with $2.8 million in cash value that I can use to continue building wealth, that I've already been building wealth with, like through utilizing the infinite banking concept to flip heavy equipment, lend on real estate deals, which is what I'm getting into now. Those are the main ways I'm building wealth with using my policy. So he's not talking about all that stuff, but I put in, let's call it 1.1 million to get to 2.8 million. And also he says down here that this is a wealth killer as illustrated. This is such a stupid thing to say. Like, come on, guys. Are we really taking this kind of stuff serious? Wealth killer? Really? So I put in 1.1 million. At 75, I have 2.8 million. I created $1.7 million in wealth just with the policy, not even taking into consideration how I built wealth using the policy as well. So what are you talking about? You're just, I don't know if you're just trying to make yourself feel good by saying stupid crap like this, but yeah, it's definitely not a wealth killer. You know what a real wealth killer looks like? An IUL that lapses at 75, 80 years old because they've over leveraged it, because you showed them taking out 8 to 10% income every single year, and you show them with an up year, the market going up every single year, and all of a sudden they run into trouble. That's the real wealth killer, dude. So don't even go there. So, but yeah, he's calling out the policy. Then he basically says, I left out the most important part of the puzzle. That's how much money you get to spend. That is ridiculous. That is not why I set up my policy. Can I take tax? Can I get good tax-free retirement income from this when I'm 75 and I got $2.8 million of cash value? You bet. I can run an illustration on it, but again, it's just not important to me right now. Like I didn't set it up for tax-free retirement income, and I'm assuming already that I'm going to be able to I'm not even assuming, I know I'm going to be able to take out a good amount of money at that time. Not to mention, this is only one policy as well. With $2.8 million of cash value, I could probably take out $80,000 to $100,000 per year tax-free retirement income. I'd say that's pretty good for one policy. And I'm not trying to take out the maximum amount that I can every single year. Maybe I will at 75. I don't know where I'm going to think about that in 40 years, but taking out the max. And also he says, take out the max for 30 years. So showing up until 100, I would actually run it to until 121 or 120, whatever the illustration will let you do it, to be even more conservative, because I'm much more conservative by nature with that kind of stuff. And so I'm not trying to take out the maximum amount of money that I can from my policy. Like, can these things be really good supplemental retirement income sources? Sure. But to say that this is the most important part of the puzzle is ridiculous. It means you have no idea why I'm setting up my policies. Like, it's pretty typical of IUL agents as well. Not all, okay, but a lot of the conversations I've had with IUL agents and the back and forth, it's just like, are you really getting to know your client here and why they're trying to set these things up? Or are you just trying to, like, you know what, all that stuff that you said doesn't matter. You're using it to build wealth. The most important thing is the tax-free retirement income. Really? That's just dumb. Sorry. Let's see what else. Now, I do agree somewhat with this. Putting this kind of money into any cash value doesn't matter if it's whole life or IUL. It doesn't make sense for 97% of the population. I wouldn't go that high, but I do agree that it's definitely not for everybody, for sure. Like, if you're not good at controlling your capital and you don't know how to spend less than you make, right? Then it's definitely not good for you. But it's definitely good for a lot of people, a lot of business owners, real estate investors, private money lenders, things like that. It's good for all kinds of people. So, yeah, the little wealth killer comment, that's just stupid. Let's see what else. Let's go through some of the replies here. So this is my stuff. You can go through it right here if you want. But he says, this is a massive wealth killer. It's not. You got a proof for you wanted to show everyone how you set it up, and that this was the illustration used when you got approved for this plan. That is correct. And you wanted to show what a properly structured dividend-paying whole life insurance policy looks like. That it is. It's not. Let me clarify. It's not the only way to do it. It depends on what you're trying to accomplish. But I would say having access to a large amount of my cash value in the first year, it breaks even in years 3 to 4. It starts growing by more than I put in by year 2. I'd say that's pretty good. So, yeah, but you can nitpick it all you want. All right. You go on to say you're showing us a real policy. I mean, it is my policy. You also said you pulled money out of the policy as a business loan and to purchase a car. This doesn't make sense. Yes, it does. And I explained why I did that. You clearly didn't watch those videos. And why doesn't that make sense? Just to say, that it doesn't make sense and you just stop there, that's stupid. It's not productive, man. So why doesn't that make sense to you? And, you know, I've done videos on why I used my policy to purchase a vehicle. It absolutely does make sense when you understand how these things work. Let's see. Go to the annual statement in-force illustration that proves this. Dude, I've done so many videos going through my policy. It's ridiculous. You said you usually recommend a first-year premium of at least double the annual premium. This doesn't make sense. He says it doesn't make sense. Why? You can disagree with me, but why? Don't just say it doesn't make sense. That's not helpful for anybody. The reason I recommend this is because you're able to put a larger amount of money to work and get that to start getting that compound growth that the policy will give you. Number one, it makes it really efficient as far as like getting access to a ton or a lot more cash value in the first year versus if you only pay the annual premium. Again, depending on the company and I guess how much you're putting into, but in the design, but you won't get access. You typically won't get as access to as much cash value as you would if you were to put a large lump sum into in the first year. That's what I've seen on illustration so far. So I don't know what you're talking about. Let's see. If you're looking for efficiency, the first year premium, along with each additional premium, should be based on the IRS maximum guideline for the death benefit chosen, which I'm pretty sure it is. Not sure why you're saying it's not. But again, it depends. Like you're putting every person who does a policy into one box. Like everybody's different on how they set their policies up. Based on what they're trying to accomplish. As for maximum efficiency, as you say, the IRS maximum premium should be paid during the first 7 years up to the MEC amount. Okay. Fortunately, illustrations tell you what this premium is. That's true. So if you're funding the policy with less than the IRS maximum guidelines, you're not structuring the policy for maximum efficiency. Okay. I already touched on the efficiency here. Next, everything you show in the policy is not likely to happen. Oh, this is fun. Okay. So he's going back to the guaranteed column. You know what's not likely to happen? An IUL illustration. A whole life illustration is so much more likely to happen. The non-guaranteed side, okay, is so much more likely to happen than an IUL illustration. So when you look at an IUL illustration here, let's go to the one that the part of the illustration that every IUL agent will say is most likely to happen, which is not. Right here, 7%, non-guaranteed assumptions, okay? This is not likely to happen right here. You know why? Because, well, there's a couple of different reasons why, but primarily for the point of this conversation is that the stock market does not go up every single year. Let me ask you this, guys. Is it more likely that the stock market's going to go up every single year, or that a company that has paid a dividend for 146 years straight is going to continue paying those dividends into the future? Which one is more or less likely to happen? Just use common sense with this stuff. It's not that complicated. This structure is a wealth killer. That's so stupid. I have $2.8 million of cash value at age 75, and you say it's a wealth killer. That is so stupid. To only earn $269,000. I put in 1.1 million. It gets to 2.8 million. He's looking at the guaranteed side, and I guess he's trying to say that I'm saying the guarantee is the only thing that matters. I've never said that. I've never said that about the guaranteed column at all. I do call out the guaranteed column in an IUL illustration because it shows it lapsing. You'll never see that in a whole life policy, but do I think that guaranteed column is going to happen? No, the stock market's going to go up. You're going to get some years where, you do good in the IUL. I never said that. So I don't know why he keeps going to the guaranteed column there. So if you discount the non-guarantees in the Transamerica policy, you have to equally, no, I don't. No. Okay. So let's finish this. So if you discount the non-guaranteed column in the Transamerica policy, which I literally just showed you, you have to equally discount the non-guarantees in your whole life policy. After all, right in your illustration, it clearly says these results are not likely to happen. FYI, I don't like Transamerica. I don't like any IULs. But okay, I just asked this question. Like these companies have never missed a dividend. So and they have nothing to do with the stock market. How on earth can you even make that comparison? It literally makes 0 sense. It is so much more likely that the non-guaranteed side is going to happen on a whole life policy, or at least close to it, than an IUL. Like, just stop, because it's based on the stock market. In an IUL illustration, that non-guaranteed assumption, the non-guaranteed assumption in a whole life policy is based on for my second infant banking policy, 146 years of dividend payments that have been made to policyholders, and dividends are pretty low right now. My first policy, they paid dividends for 119 years straight. So you know what has not happened for 119 years straight? The stock market going up every single year. So just stop it, man. Oh my gosh. All right, it might be stupid and unproductive because I basically said, like, saying things like wealth killer and like resulting to name calling and just, doing personal attacks and bashing and stuff like that. It's just not a productive thing to do, in my opinion. Especially when he says wealth killer, and just by like his very statements, it doesn't make sense, because my cash value gets to $2.8 million after I put in 1.1, and then it's going to continue to grow after that too. Wealth killer, really? Let's see. He says it might be stupid and unproductive as a result of you trying to push it off as a wealth building tool. It absolutely is. But what's actually stupid and unproductive is a less than 1% return. You're looking at the guaranteed column. That's just ridiculous. Your illustration produces, you know what your illustration produces? A big fat goose egg. How much of a wealth killer is that? Return for the guaranteed side, and only 3.9% for the illustrated guaranteed, non-guaranteed side. Okay, so let's talk about that really quick. So if I were to ask you guys, or tell you guys, like, hey, I just found this bank down the street that's offering a tax-free savings account that's going to compound for the rest of your life, 4%. You don't have to pay taxes on it, and you don't even have to take the money out in order, which would interrupt the compound growth. You can still use the money. You're going to pay a little bit of interest, but you can still use the money to go build wealth. I can lend on real estate at 12%. I pay back 5.5%, but so I made money on the real estate deal, and I continue to get that uninterrupted compound growth. Would that make sense? I mean, I would think so. So like for a savings vehicle, 3.9%. Again, which is typically what these policies will do, 3.5% to 5%, depending on the company, how you design it, and all that stuff. To me, that is a really, really good savings vehicle. When we look at the probability of this illustration working as shown, man, I hope you say the same thing about your stupid IUL illustrations when you're showing 7% every single year, uninterrupted, as if the market's going to go up every single year. I hope you have the same exact conversation with your clients about IUL, because what you see in an IUL illustration is absolutely not going to happen. Very, very likely not to happen. It's much more likely that a whole life policy or a whole life illustration will. So yeah, anyways. All right, so that's that one. I think there was one or two more that we can go through here. That's fun. Oh, wait. Okay. So I already went through that one. Let's see. What else do we have here? Okay. So this one, yes, like the back and forth on here is like, look at how long these comments are, man. It's just insane. I don't know if I want to go through this whole thing, but you know what? Whatever. We're here to have some fun. So let's do it. Let's see. All right, let's go to this video. So this is all the reasons I don't like indexed universal life insurance. Yeah. Okay. I don't remember where this conversation actually started. I think it started on another video. Okay. We'll break this one down. Interesting. You're quick to ask another question, but slow to answer my initial questions. I actually answered all of his initial questions in the first episode of Fun with IUL Comments, but he did not watch it because it's too long, I guess. But he got no problem watching my other videos and leaving, essay style comments in them. So he's got time for that. He's disappointed. Boo-hoo. I'm sorry. You create a video providing an overview of an IUL funded for cash value, and then you invite people who recommend IULs in a boastful manner, talking about how much fun you're going to have with all the comments from people who recommend IULs. Actually, you did not take me up on that offer because you still refuse to get on my channel. So nice try. You're putting a lot of misleading, biased information out there. Yeah, like all the comments that you're leaving about whole life right now. Nice try. Misleading bias information. I call that to your attention. I asked you for specific pieces of information instead of providing information which is right in front of your eyes on the illustration that you previewed in your video. You've chosen not to do so, blah, blah, blah. You showed very limited information and purposely hid columns on the illustration. I didn't hide anything. There were some columns or some pieces of information that were blacked out for privacy purposes because that was a real policy that was sold to somebody and they didn't want their name and all that stuff. That's the only thing that was blacked out, but I'm not purposely hiding anything. I'm not misleading anybody. I hid the guideline level premiums. I already said in the video that he's talking about that that particular, the Transamerica policy that I've been showing you guys, that's the one I did, I broke down in this video. It's the same one. I said it's not funded properly, but in my opinion, it doesn't matter if an IUL is properly structured anyways. It's still not likely going to do what people say it's going to do, what it's illustrating, because the market doesn't go up every single year, guys. Like, I don't know what is so complicated about that. This will be the 7th time I've asked you to provide information you used with that illustration. I didn't use the illustration. That's what was sent to me. And from somebody who, once he learned how IUL actually works, he ran the other direction just like I did and was extremely disappointed by his policy. But I've asked you 7 times to get on my channel and have a conversation with me, and you refuse to do that. Let's see. It happens. I finally took a look at the video you sent me on the properly structured whole life policy. Policy claim yours is in force. You show the entire illustration with the whole life policy demo. You show all the columns from left to right. Dude. All right. This tells me you clearly see. This is why, like, you know, this is just not a productive comment at all. Like, maybe, I don't know, maybe I'm not going to go through this whole thing because, but we're having fun. You stated cost of insurance fees inside of a whole life policy guaranteed to be level. I've never heard of anything like that before. And apparently neither. But okay. Yeah, we were going back and forth on this. Like, basically what I'm saying is that when you look at your whole life policy, when you look at the illustration, like the fees inside of a whole life policy will not go up. So for example, like in a whole life policy, when I'm 75 years old, okay, and I've stopped making premium payments, one, the policy is guaranteed to grow every single year. Okay, that it's guaranteed contractually inside of the policy, not the dividends. Those are not guaranteed, even though they've paid them since their inception. All right, but I'm not going to get a bill from the company at 75, 80 years old when all of my cash value is just been destroyed by cost of insurance. I've over leveraged the policy by taking 8 to 10% every single year. Market didn't go up every single year, right? And now I have to make a premium payment more than what I have before in order to keep the policy in force. Like, everything is level. Everything is spread out throughout the life of the whole policy, for the whole life policy. And, you know, maybe there's a different way to explain that. I don't know. We can get into the semantics, but, you know, when you look at the difference between an IUL policy and a whole life policy, like the whole life policy, the costs and fees, they are level and spread out throughout the entire whole life policy. Maybe there's another way to explain that, but we're getting into the semantics here. And I'm not sure that that's really useful. Let's see. However, I'm thinking you may have read it. Company's website, compliance by all means. Yeah, still okay. About the fees and costs being level, whatever. Any guarantee. Next, in the IUL video, you harp on the fact the 3.5% midway illustrated rate is figured as a straight computation, and then you turn right around in your whole life insurance video, and guess what? It's figured the same exact way. No, it's not. No, it's not. No, it's not. Whole life policy, non-guaranteed column, dividends that have been paid since their inception. The crediting inside of an IUL policy based on the stock market going up every single year, which is not going to happen. So it just doesn't make any sense. I wonder why you didn't bring that to your viewers' attention. I've said that many times. Can't complain about one product showing illustrations based on, look, I don't have an issue with non-guaranteed rates, so to speak. I have an issue showing the the crediting of the growth of the policy, showing it growing every single year based on a stock market product. It's based on the performance of stock market indexes. The stock market doesn't go up every single year. So it's not the fact that it's not guaranteed. What's more likely to happen, though? Dividends being continued to be paid from a whole life company, or the stock market going up every single year? So yeah, I actually I can talk about and complain about how those illustrations are computed. No, it illustrates the rates of return the same exact way. Oh my God, dude, are you serious? Maybe I'm misunderstanding what you're saying here. I'm trying to give you the benefit of the doubt, but when you say stuff like this does not make any sense. You're saying that the same way that a whole life product illustrates is the same way an IUL illustrates. You're saying it's the same exact way. Woo, man, I hope I hope you don't tell your clients that. On page 6 of your illustration of a whole life product, you illustrated under the section that says other important information. It says this has been prepared based on 100% of the company's current dividend scale. That's correct. This illustration assumes that the currently illustrated non-guaranteed elements will continue unchanged for all years shown. This is not likely to occur, and actual results may be more or less favorable than those shown. Okay, I don't deny that. It's not the dividends are not guaranteed. But again, if we use common sense here, dividend rates are the lowest that they've ever been for a lot of these companies. And what has happened over the past year or two? Interest rates have gone up. That is good for the general fund of these whole life companies, which means that at the time I've set my policies up, when the dividend rates are the lowest, I'm setting it up at a really good time. I'm likely going to experience points or years where the dividend rate is higher because of the interest rates going higher. So, like, here's the other thing too, is that I can prepare the illustration. So like if dividend rates go up pretty significantly, let's say that dividend rates go up to let's say 7%. Okay. And I'm pretty sure that eventually the Fed is going to cut rates again. And so I want my illustration to reflect that instead of 7%, for example. Well, I don't have to illustrate at 100% of the company's current dividend scale. I can do 70% or 80%. To make to go back to that conservative, 5.3% dividend rate. I could do that. And I don't know if you can do that with an IUL showing 0 years. I've never seen an IUL illustration show 0 years. You guys absolutely should, but then you probably shouldn't, because then you go out of business because nobody would buy it anymore because they would see the impact that 0 years have on their policy. But I digress. Yes, okay, so they're not guaranteed, but I can adjust the dividend scale, which I will do. If dividend rates get high, and just to be more conservative. But I didn't do that because I feel like dividend rates for whole life companies are at their rock bottom. So I don't need to adjust that scale at all. So yeah, I mean, look, I appreciate you bringing up that these things are not guaranteed. That is absolutely true. But yeah, the reason I did 100% of the dividend scale is because I'm confident, the dividend rates are probably not not going to get too much lower because they've already been low. If anywhere, they're likely going up a little bit in the near future. So you can't call out one product for showing guarantees. And the way they compute the returns in the illustration with a product you like and promote does. I don't know why you're saying this twice, unless you're just talking about the guaranteed column. But we've already. I'm not going to beat a dead horse with the guarantees. Guarantees are useless in an IUL. It just shows the policy lapsing. You're not going to see that in a whole life policy. You certainly can't compare a quote unquote allegedly cash value IUL illustration with a premium of $2,400 versus a whole life insurance policy. I wasn't trying to compare numbers. If I did, I apologize. But I was talking about design of the policy. I think I have to go through the video again, but I doubt the illustration in your whole life videos. I could be wrong, but if it is, call the company and do an in-force illustration. I will do a video showing you guys an in-force illustration. I'm pretty sure I've already done that. I'm pretty sure I've shown it in multiple videos, but I'll make one specifically for you. I get it. Fake it till you make it. See, this is what we deal with, guys. In this industry, this is just stupid and unproductive. Like, if you want me to come on your channel, shoot me. And actually, what I told him is like, okay, you want to get on the channel, or you want an in-force illustration? Let's go through my in-force illustration and all of your questions live. Why can't we do that? And I did that. And I mean, you guys can go through this. I don't remember his exact response, but he did not like my response. He was like, I'm not doing that. Okay, well, do what you want. All right, just keep trolling in the comments. Stay safe in the comments instead of coming on my channel and debating me on this. But, those are some of the interesting comments that I get on my videos. I hope that was a little bit entertaining for you, but more importantly, educational. I hope it was a little bit educational for you, because a lot of the things he said just don't hold weight. It doesn't make any sense. Comparing an IUL illustration, or saying that the way that a whole life illustration is presented and created is the same exact thing as an IUL illustration. That's a joke. I can't believe, and I've heard that from a couple of IUL agents. I can't believe people say that. That's like, they couldn't be more opposite. Your IUL illustration is based on stock market performance, part of it anyways. And you show the stock market going up every single year. With a whole life illustration, it has literally nothing to do with the stock market. So I don't know what you're talking about. Anyways, that was fun for me. Hope it was fun for you guys. If you have any questions, drop them down in the comment section below. I'd love to hear your thoughts on this. It's a good time for me. And yeah, we'll see you in the next episode. Hope you guys are crushing it. To your success. Matty Ice is out.